on today's episode of the Home Guys podcast.
And a lot of real estate experts are saying this is the same pattern that we saw leading up to 2008.
Kind of a group of guys on YouTube like Michael and there's Reventure, Nick Gurley, and a couple other guys that are, I think people kind of call them the housing doomers. I think they got a lot of traction in the last 4 or 5 years because the housing market was so overvalued, and negative content goes viral much better than positive content does.
Enjoy the show.
Hey guys, Jaden here today, just coming at you with a reaction video. This guy, Michael Bordolano, I think his name is. He's out of Florida, Miami area, I think. I follow him quite a bit. He does a lot of walking around videos of Florida and talks about the market quite a bit. Pretty interesting guy. He has a kind of a negative take on the market usually, but it's good information nonetheless. So we'll watch this, and he says the home sellers hit the panic button. So let's see what he says about it.
A lot of people are skeptical to call the current situation with the housing market a housing crash. And I think that simply just boils down to the fact that there are still many places where home prices are going up, but there's also a lot of places where prices are coming down. So compared to 2008, Americans are just not all on the same page. Back then, almost every single housing market kind of started dropping in unison. Whereas today, we've seen markets that have been going down for years and others that are still going up even in 2026. But make no mistake, whether you want to call it a crash or not, the housing market is collapsing, guys. It is in all-out panic mode right now. We just got the latest data for what's going on with home purchase agreements. And there were about 40,000 purchase agreements canceled in January, which is about 14% of all homes under contract. This is basically a record cancellation for January numbers. And that number is also up 13% year over year. This is the highest amount of cancellations in about a decade. And a lot of real estate experts are saying this is the same pattern that we saw leading up to 2008. I mean, how many different things do we have to see that mirror 2008 before people kind of get on the same page?
So he said a lot there. Michael's been pretty negative on the housing market for a number of years. He lives in Florida, I think in Miami area. So, Florida market is definitely different than the rest of the country. I live in Sarasota, Florida. So take that with a grain of salt. I mean, he's very negative on the market in general. He's been saying this kind of stuff for probably 4 or 5 years now. And some of it's true. The market is correcting. The market in Florida is correcting. Prices have been falling essentially since 2022 in Florida, but they're not falling fast. They're falling a couple percent a year for the most part. In most areas of Florida, most types of housing is not crashing. I'd say it's falling single-digit percentages every year. It's like a slow motion crash. So if you look back over like a 8-year period, you're like, well, it would have corrected by quite a bit, but it took quite a while. So, and I think one thing people forget about, like when they say 2008, I was in real estate at that time and before that, and people forget like everything crashed in 2008. But if you look at the actual data, like in Minneapolis, Minnesota, where our business is at, the market really shifted in late 2005. 2005 is basically when it peaked, and 2006 it kind of flatlined, and then started coming down a little bit, getting softer. And foreclosures started happening in 2006 and 2007. And then you started seeing the softening in 06, 07, and then 08. I think 08 is everybody's conscious memory because of Lehman Brothers and Bear Stearns collapse in 2008. And then there was all the bailouts and stuff. But the housing market was already going down before that. That's why those things happened, is because the market was going down, which triggered all the foreclosures and everything else that happened from it. So that entire 08 thing really was like from 2006 through 2013, I would say. It was about a 7-year correction. So it did not happen in 2008. It was like 7 years. So people, this housing market doesn't move that fast. But people like to remember it like it did or whatever. And I think 08, you probably had a bigger drop in 08. Maybe it was a 15% drop. We'd have to look at the numbers. But and we also had all those foreclosures that were hitting the market that was causing those massive drops, which we don't have now. So right now you're just relying on house sellers that don't necessarily have to sell, dropping their price at will, and people are stubborn and they don't want to frequently. So it's really slow. So until someone has to sell or there's a foreclosure or something, the prices are just really slow to move down. We are seeing in Minnesota, so I'm in Florida. The Florida market's been correcting since 2022. So, we're on year 5 now or so, 4 or 5. And in Minnesota, it's not corrected. It's actually gone up for the last 4 or 5 years. Like he's saying, some markets are up and some are down. And I think it's, even the last 12 months, it's up a little bit in Minnesota. It's definitely kind of a weak market, but prices are still inching upwards there because it's a little bit more affordable than other areas. So, yeah, so interesting stuff. You said 14% cancellation rate. We've seen cancellation rates like that in Florida for the last 5 years, 10% plus cancellation rates. So that's not new here, but maybe it's new in the rest of the country. So it does say that people think the housing market's getting cheaper and weaker, so they're more likely to cancel a deal because they can just wait 6 months and get it cheaper. So it is it's kind of foreshadowing people think the market's getting weaker. And I think as everybody starts to feel that way, the buyers start to pull back even more, and then the prices will start to correct more. So that's kind of what we're saying, that we might be on a shift here where it starts to move down a little bit more. But again, you don't have a catalyst like foreclosures that's going to really drive a crash. The supply has to come from somewhere. And if sellers don't have to sell and they're really stubborn on pricing, it's not, it's hard to see a crash. Depends on how you define a crash, I guess. But another thing to note in Florida is you could say prices have crashed here. You could probably make that argument, but a lot of people that live here don't feel that way because when your house doubles in value in a year, basically in 18 months, and then it drops 5 or 10% a year for a couple of years, it doesn't feel like a crash because it's still worth a lot more than what you bought it for 5 years ago. So it's really not, unless you bought it at the absolute peak and are selling now, which some people did, then you're probably feeling some pain. But that was essentially like a 1.5 year period, 2021 to 2022, where it was really overpriced. So as long as you didn't buy in those years, you're probably fine. So anyway, let's watch some more of this video.
Page. Well, honestly, I don't think anybody's ever going to be on the same page entirely, just because that's the state of America now, right? Everybody wants to have a different opinion, whether it's about politics, whether it's about real estate, whether it's about the economy. People just want to be right, okay? And they just want to stick with their side, and they want their side and their team to win. No one even cares about facts anymore. They just care about their team winning. But I care about the facts, and I would assume a lot of people who still watch my channel do as well. And that's why we need to take a look at the facts. And the facts are that a lot of buyers are pulling out of these deals at the last minute. First-time buyers are especially vulnerable right now because they don't have any experience, right? So the first thing that comes along that can spook them, they're going to be out. And then you have a lot of buyers second guessing their purchase due to all the economic uncertainty. I mean, you have to be rock solid right now.
So everything you're saying there is accurate. In Minnesota, we actually haven't seen a lot of cancellations on our properties up there. So we're not seeing that with the stuff that we're selling, but we're selling things that are more at affordable price point. So I can just tell you from the data that we have from our little neck of the woods, at those price points in Minnesota, does not seem to be happening that much. We might be having like a 5% or something like that. So, but yeah, if people are getting concerned about the economy or if the prices are going to drop, and the first-time home buyers that are already nervous anyway, prices are still too high for most people that are first-time buyers. They're still very high. They're really stretching themselves to buy a house. So they're going to make sure that it's, they feel really good about it. And if they don't, they're going to back out of it. So, yeah, I do think prices need to correct in a lot of the country. Some of the cheaper, more affordable areas, I think even Minnesota, they could correct a little bit. Probably not, they don't have to come down as much as some of the areas that got really crazy. But I was going to also say, I owned a house in Venice, Florida, just south, about an hour south of Tampa, that we lived in. And we moved to Sarasota area from a little north. And we sold it, or we moved in 2022, which was like kind of the peak of the market. That's when the rates started going up. And I saw the rates going to 7%, and I'm like, we need to get out of this house and sell it. before the prices dropped, and I thought they were going to collapse because the rates went from 3% to 7% overnight, pretty much. And that house, even now, 4 years later, almost, has not dropped in value that much. I think it's gone down. I just checked on it. It's down maybe 8% in 4 or 5 years, and it's been hit by 4 hurricanes. It's been hit by 4 hurricanes. Interest rates have, went from 2.75% to 7%. Insurance rates tripled. Property taxes doubled, and the price didn't come down that much. So, I do think those prices need to come down, but I don't think that doesn't sound like a crash to me. And I thought the price would crash there. I really did. So I think Michael's been talking. I think he's like looking at the data, like, what are these prices going to come down? It seems like they would have come down a long time ago. They're just really slowly coming down. So I don't know, if this could be a drawn out 10-year period. Maybe we could have inflation go for 10 years and house prices just kind of like stagnate or slowly drop for 10 years. That could happen. Unless there's something to instigate some sort of surge of inventory, it's hard to foresee a crash. So foreclosures can do that, because foreclosures usually will sell at 20% below market value. So those really hurt the market. But normal sellers don't seem to affect the market in that way. A lot of normal sellers will just pull their house back off the market if it doesn't sell for the price they want. So they'll just, you'll see somebody they'll try to sell it, pull it back off, try to sell it the next year, pull it back off. I've seen some properties for 5 years. Every year, it's not a good way to do it, because every year they're dropping the price 20 or 30 grand or whatever, because they were way over to start with. Not a great way to sell your house, for sure. But a lot of sellers don't understand the market very well, so they think that's the way to go. So anyway, yeah, I think he's got some interesting points. It's keep an eye on the market. Things are changing all the time. We are at record low mortgage applications, like the lowest buyer demand, I think, in like 40 years, 50 years, something like that. So very low buyer demand. We have, I think, immigration is very low levels because of the Trump policies. And I'm not a political statement, I think that's just in the data. And also with this deportation stuff, you have potentially housing being freed up if people aren't being deported, or if they're going back home voluntarily just because they're scared or tired of this. So you could have housing being freed up from that, and also housing demand not happening because these people aren't going to go buy a house now, or even rent if they're concerned about being deported. So you have that going on. You got the AI thing affecting people's jobs, potentially people being worried about that, so they don't want to buy houses. So yeah, you've got record low demand. We just haven't seen a huge surge in supply. So if we do see a surge in supply from something, be it foreclosures or Wall Street selling off houses or investors or whatever, it could affect the market. But we've been waiting for four years, and it still hasn't really happened. So we'll see. But yeah, we want to go ahead and roll this again.
With your anticipation of future income in order to participate in this housing market, guys.
It's time. The Genesis signature event going on now.
If you had to choose between flipping a house or flipping dirt, what would you pick? Here's the truth. Land beats.
If there is even a hint of uncertainty that you might lose a job, or there's been rounds of layoffs happening where you work, there's a good chance that if you were thinking about buying, you're not anymore. And the records are showing that people who are using basically all of their life savings to pay for a down payment are very likely to cancel a transaction versus somebody who has extra cash. And if you think about it, that makes perfect sense, because you're throwing everything you got into this deal. And if anything goes wrong, whether with the transaction itself, you find out the house has problems afterwards, which we're going to talk about later in this video. A lot of people are losing big money right now due to problems with houses. And even if none of that actually happens, you still have the economic uncertainty. If you are relying on a W-2 paycheck right now from an employer, you are especially vulnerable. Business owners are vulnerable in their own way, because businesses can go from successful to tanking overnight. But a lot of business owners that have been in.
Yeah, so I mean, good point on the W-2 thing. We're starting to see just little bits and pieces of this kind of stuff. The company used to be called Square, is now called Block. They're a credit card company, and they just laid off about 40% of their workforce. And they claimed it was because of AI, and I think AI may have been part of it. But I think a lot of these tech firms way overhired people during the pandemic. They were just hiring like crazy, and I don't know if they were being paid by the government to do that or what the reason for that was, but they did, and most of them did not, even with some layoffs, are way higher staff than they were 5 years ago. And so I think you have a lot of resetting. Like Block their revenue hasn't grown that much the last year or two. So if you get to a point where these companies aren't growing, that CEO is pressured to make something happen for the stock price. And if they can't grow the revenue, they're going to lay people off. So that's what Block did. And we might see some more of that if you don't have revenue growth at some of these tech companies. But it's going to hit tech companies first. I don't know when it will roll down to corporations, like big companies in Minnesota, like Target Corporations up there, Best Buy, Cargill, United Health. Those are big, slow companies, and they don't tend to lay people off unless they're really having economic pain, like there's a recession or something. So if we get to a recession and they have, the revenues are declining and they're really in some pain, then they'll lay people off. But they, if they're just going to lay people off because of AI efficiencies, geez, that could take years before they do that. I can't foresee that happening very quickly at those companies, but tech companies could do it quickly. I think out in San Francisco and San Jose, that could happen fast. So let's roll it some more.
Business for a few years can at least adapt and recognize the trends before it's too late and kind of pivot and still keep some sort of an income coming in. Whereas when you lose a job, it all just dries up overnight. Now, one of the other main drivers of these record cancellations right now is people are looking at their payments. And once they get all the information, because when you first make the offer, you don't fully know what your monthly payment might be, because once you find the property and you make an offer, that's just to get your foot in the door. You might make an offer right away just to get your foot in the door and secure the deal. But after you start running the numbers and you get an insurance quote and you look at what the property taxes are going to be the year after you buy, suddenly the monthly payment picture changes. And people are realizing this. People are getting smart.
So you made two really good points on property taxes and insurance. So when you go to buy a house, when you run the numbers, usually you'll run the numbers based on the property taxes that are currently being paid. But if it's a house that's been owned for a long time, their taxes could be much lower than what they're supposed to be because they just haven't been assessed properly over the years. Assessors, like if you stay in your house for a long time, the assessors just kind of like, I think it's an automated assessment thing. It just doesn't really, they don't look at it that closely. So I've seen stuff in Florida where the taxes double or triple or quadruple when the house sells. Florida also has rules about when you're homesteaded that your property taxes can't go up more than a certain amount every year. So you've got to be careful with taxes being possibly much higher than what the current owner's paying. So that's one thing. The other thing is insurance is another one. Make sure you get some insurance quotes because especially in Florida, like you might find that your insurance is 3 times as high as what you thought it was going to be, or 5 times as high, or 10 times as high. There are places in Florida now, places that you wouldn't think are in flood zones that are now, or in hurricane-prone areas and things. Certain ages of houses, if they're older than certain years, they weren't built to the current hurricane codes, so older than 2000, they're a lot more expensive to insure. So, yeah, just a lot of stuff to think about there. Let's go ahead and roll it some more.
They're seeing videos like this and they are doing the math ahead of time and realizing, wait a minute, this is going to cost an extra $400 or $500 a month that I wasn't anticipating. I'm out. And also the fact that the housing market has been rapidly shifting towards a buyer's market in many different metros across the country. This has led to a situation where we have about 500,000 more sellers than buyers nationwide, and inventory is back to pre-pandemic levels, essentially. Buyers have way more negotiating power. There's way more options. So it's easier to back out of the deal if something doesn't smell.
It's been a really good point there that's actually kind of interesting, that everyone's saying that the housing market is crashing and there's all this supply and all this stuff. And he just said, well, it's back to pre-pandemic levels. Well, pre-pandemic levels in most markets were still very tight for housing, and house prices were going up every year. It was very tight. It was hard to buy a house. This was in 2018, 2019. It was not easy to buy a house then. It was expensive and tight inventory, et cetera. So if we're back to where it was then, I would not call that like a really loose buyer-friendly market. I think one difference now is we have less buyer activity. So we have maybe the same supply we had back then with less buyers in the market. So I think right now it probably is it's a better market now, but prices are higher than they were back then too. So kind of a balance. But yeah, I do think that if we don't have interest rates come down, another point or so, the market's going to keep softening slowly. I don't think these guys will talk about crashes and all this extreme stuff happening because I think it gets views, but the most likely thing to happen is what's been happening for the last 4 or 5 years is like this slow motion trickle down in pricing is what's going to keep happening, I think. And it might start happening in other places, even like Minnesota might start seeing some slow price declines maybe. But I think the Midwest will be maybe the least affected of the entire country because prices didn't boom during COVID. So they shouldn't have a whole lot to drop there. But Florida, we might not see price increases in Florida for, it might be 5 or 10 years before you see prices go up here again. Could be 10 years. So go ahead and roll it somewhere.
All right. During your due diligence period, or even at the last minute, even if you have to lose that deposit, losing 10 grand sucks, right? I would rather lose 10 grand than 100 grand or 400 grand on a bad deal, right? And some cities across America are actually seeing much, much higher cancellation rates than this 14% average right now. San Antonio, Texas, over a 21% cancellation rate. Atlanta is at an 18.5% cancellation rate. Cleveland, Ohio is at an 18% cancellation rate. Riverside, California is at 17.5%. Orlando, Florida is at 17.3%. And this is what you start to see happen when sellers start to outnumber buyers by a wide margin. Even in areas where the cancellation rate is lower, it's still there. And here's the thing, guys, like some people might get scared and freak out that, wow, a lot of people are canceling deals. Maybe I should cancel mine too. I don't necessarily think you should think that way if you're a buyer, especially if you've been doing your homework and you do find a solid deal. But what I will tell you is that now that things are moving more in your favor, this is good news. It means you don't have to jump into a deal that you're not 100% about. It means that you don't have to let the seller make all the rules. You definitely don't have to overpay. And if you're in a market where that's still happening and you're still seeing multiple offers and things like that, well, then you have to decide if you want to participate in that frenzy, even though the general market is moving in the opposite direction.
That's
because there's a good
there.
chance that.
So another good point he made was it's better to buy a house right now than it has been probably in 10 years in most markets. I would say at least 10 years. So you're going back to 2016, 2015, because in Minnesota we're seeing, and down here in Florida too, that if the buyers have a lot of power now, so they can get everyone, you can do inspections, you can ask for repairs, you can ask for your closing costs to get paid, you can get negotiate the price down. You can pretty much ask for anything, so you might as well ask for a laundry list of things, and see, push for as much as you possibly can, and then add a couple more things that you don't even want, and let them negotiate them off. So yeah, it's a good time if you are in the market to buy a house. I just say at the end of the day, like, you got to live your life too. So you can't always just be like, what's the market doing? Like, pay attention to what the market's doing, but you also need to live your life. You need a place to live. And I don't like living in rental properties personally, because it doesn't feel like home to me. I can't do anything to them. To me, there's a lot of value in just owning a home. And even down here in Florida, we own the home we live in. And I know it's going down in value, and I knew that when we bought it. And I just planned for it to be worth, substantially less money than what we paid for it. And I was okay with that because I want to own my house that I live in. There's a value to it, to me, not just a financial value. So, but if you look at it and say, hey, it's not worth, $100,000 extra cost to me over a 10-year period. Or the other thing is, if you wait 10 years, that you'll probably get it back because the prices will rebound and come back again. But I do think, especially in Florida, like you need to be looking at it like, you might lose $100,000 of value in your house in the next five years or so. So if you're not comfortable with that, then probably don't buy a house down here. Minnesota, I don't think you're going to see that level of drops. I think maybe $50,000 in some places for higher price houses could be possible, but probably more likely like 10 or 20 grand, which isn't. I mean, that's over a 5-year period. That should not be that big of a deal when you average it out over the years. So yeah, go ahead and play it some more.
That could come to an end sooner or later, even in hot markets. But I think people should be heavily evaluating their financial situation more than ever right now. Forget about what the bank tells you you're allowed to spend. Forget about what friends and family say about owning versus renting and that renting is a waste of money and all of that nonsense. Listen to what your finances and your instincts are telling you. If it doesn't feel right, definitely back out. You literally have nothing to lose, guys, because we're going to talk about Zillow's home price forecast in this video as well, and it is essentially non-existent. You don't have to really worry about prices shooting up in most of America right now. But first, before we talk about Zillow's home price forecast, let's talk about the home repairs that are catching many homeowners completely off guard right now. Because as of last year, about 85% of homeowners spent money on unplanned home repairs. Okay, and this is a report from Clever Offers, which is a platform owned by Clever Real Estate. And once you hear this information, it's also going to give you something else to consider before pulling the trigger on buying a home right now. Half of American homeowners right now say their home needs repairs or renovations that they cannot afford to do. That is huge. Because if you live in a house, which is 50% of these people, and you can't afford to make repairs, not only does the value of your house deteriorate, but that deferred maintenance starts to pile up. And as it piles up, it can become even more costly to repair down the road if it's not addressed when it's still an early issue. Think of things like roofing issues or foundational issues or plumbing issues, things where the longer you put it off, then the worse it can get. And 65% of homeowners admit that they are now actively ignoring home maintenance tasks that need to be done within the past 5 years. Guys, past 5 years is a long time. So you defer maintenance on something essential over the past 5 years, that can go from being a $20,000 repair to a $50,000 repair, all just because you didn't take care of it early. And here's what I mean. Putting off maintenance actually resulted in repairs that could have been avoided for nearly 1 in 3 homeowners. And of those, 72% spent at least.
That's interesting. 50% of people are not doing the repairs, some of the repairs that they need in their house, or up to 60% in some cases, it sounds like. So I think the last time we saw this was in 2005, 06. This was pretty common, that people got really stretched on their houses because the prices were very high like they are now. And so people would buy houses. I think a lot of times people don't think, especially their first time home buyers, they think, well, there's the mortgage, there's the insurance, there's the taxes, and maybe there's an HOA. And then if I can afford that, then I'm good. And they don't think about, replacing a roof can cost $20,000 to $40,000. And roofs don't last forever. They last, if you buy an existing home, you might have less than 10 years or less than 5 years of life on it. And hopefully your inspector called that out for you if it was less than 5 years. But sewer lines can be $10,000 to $20,000 if you've got to repair or replace those. Houses are very expensive. Houses I've bought in Florida down here. It's like when I buy the houses, I'm putting in tens of thousands of dollars to fix things up that were deferred, and then when I sell them, I'm usually doing it again, another $10,000 or $20,000, updating to the latest things to try to make it show ready and stuff. So. Make sure if you're buying a house, make sure you've got, I would say, 10 or 20 grand extra, unless you're really handy, you can do the work yourself, somewhere that you have access to, so you can replace a roof or a sewer line or a foundation problem or whatever comes up. That's this is concerning. Like if you've got that 50% of the population not fixing their houses up, if we have stagnating prices for a long period of time, which we probably will, likely outcome of that is we'll have more foreclosures is what will happen, because those houses will deteriorate in value. The value isn't going to go up in the market, so it's not going to cover them. And when they do eventually have to move for whatever reason, in 5 or 10 years, they won't have enough equity to sell the house because the house is deteriorated and it's not a sellable condition. So we might see that. We might start seeing foreclosures at some point in the future. I haven't seen them yet. We don't see very many still. I mean, we're 4 or 5 years removed from COVID, and I see very few foreclosures. So I don't know, if we're going to see them, I don't think it's in the near future. I really don't. Maybe it's 2, 3, 4 years. If we have a recession and unemployment, that could change things. But I just don't. Yeah, I don't know. There hasn't been much of a foreclosure thing, and I think the government programs to prevent foreclosures are very strong now. So I just don't. I don't know. I don't know how much of a factor that will be again. The government won't let 2008 happen again like it did last time. I can tell you that it's not going to happen. And I know a lot of people that were buying properties in 2008. I did as well, and through that period, a lot of people think that will happen again, and they can capitalize and buy houses like that again. I wouldn't be waiting for it. I know some people have been waiting for a long time for that to happen again. And I don't think it's ever going to happen again. I really don't. Not like that. There might be some other version of it, but not like that. So, yep, we'll go ahead and play it some more.
It's $1,000 on a preventable repair, and 44% spent at least $5,000. This goes back to what I tell everybody who wants to be a homeowner. Yeah, it's great. You buy the house, you spent your life savings on the down payment, you put only 5%, 10% down, you still have PMI payments, and now, oops, you got to come up with an extra $5,000 by surprise. Do you have that money? If you can't answer that question as a yes, then you probably shouldn't be buying a house right now. Also, among homeowners who have renovated in the past 5 years, 70% say that it went over budget, and 58% have at least one regret, including spending too much money. And 22% say that the renovation took too long. Nearly 1/3 of homeowners have gone into debt completing a renovation project, and 19% had to stop a project halfway through due to unexpected costs. Over half of all Americans.
So yeah, a few things there. I mean, basically every construction project in the history of mankind has gone over budget and over schedule, I think. So that's not new. Like if you're doing anything significant, it's going to take longer and be more expensive than you think it's going to be. So that's pretty much for sure. The other phenomenon with owning a house is that I've learned over the years is that once you own a house, if you start fixing anything up, it's like a really slippery slope. You got to be really careful, because if you start going, I'm going to start improving this house, where do you stop? And it's almost better if you just don't start. So I've had a couple houses when I was 10, 20 years ago, where I just we were younger and we were saving money, and I just decided we're gonna budget as little money on keeping the house maintained as possible. I want to keep it maintained in a good condition, but I'm not gonna update or improve anything. And I did that for probably a decade pretty successfully, but it was because it was like a red line. I'm not improving or renovating anything, because the second that we do, I think most people are like this. The second you do, well, I have a really nice, kitchen countertop, but the cabinets now look old. Got to do the cabinets. I just did this in a new house that we just bought. I ended up renovating the entire kitchen that I was not planning on doing, because we had fixed up a bunch of other stuff in the house that needed fixing, and I updated and improved it, and all of a sudden the kitchen looked really old and terrible. So I was like, well, I'll just do a little bit of the kitchen. And by the time I was done, I ended up doing the entire everything. Whole new kitchen. So now I'm like, okay, now I'm seeing the windows are old and all the roof's old. And so you got to be really careful with that kind of stuff. If you can get into a house that's in good condition, but maybe is not updated, and you can just tell yourself, especially if you're younger, just try to be okay with it and keep it in good condition and working well. But you don't need to have the latest trends and stuff, because it's a very slippery slope. Once you start doing things, And we do this. We renovate houses when we're renovating houses that we fix up. We have to kind of decide like how far do we go with it? How far are we going to renovate the house? Are we going to do it? Because if once you get past a certain point of renovation, you kind of have to do the whole house. You got to do, okay, now we're doing all the bathrooms, we're doing the kitchen, we're doing the paint and the carpet, the light fixtures and everything, the windows and everything else. It's like kind of either that or a really minimal, we're going to get it, looking fresh and clean and safe and work, like fix all the problems that don't work, but not update it. That's kind of the two different things you can do. But yeah, you got to be careful with updating houses. It's very expensive. And especially if you update to a modern standard in an older house, if you just update one part of the house, then the rest of the house starts to look old and it doesn't look right. So that's where you can get into spending a lot more money than you thought you were going to spend. So go ahead and roll some more.
58% to be exact, have nothing saved for emergency repairs around the house. And among those savings for renovations, 32% have less than $5,000 saved and 60% have less than $10,000 saved. So even these so-called equity-rich homeowners, they talk about how Americans are hanging on to a record amount of home equity right now. They are cash poor, guys. They don't have money, which means that if you want to actually take advantage of that equity, you're going to have to borrow against your house to do all these things, because most homeowners don't even have 5 or 10K for an emergency or for a renovation that has to be done. And about 46% of Americans plan on spending more in 2026 than they had to in 2025 on renovations and repairs. 46% also plan on spending $5,000 or more this year, and 28% plan to spend at least $10,000 or more. No wonder why home equity loans and home equity lines of credit are the fastest growing form of consumer debt right now. People are renovating and making essential repairs, whether they can afford it or not. They just say, hey, let's let the house pay for it, and we'll worry about how we're going to make these payments later. And if you think this doesn't happen to everybody, oh, you're just being dramatic, Michael. Well, take a look. This is what homeowners actually have to say. 51% of homeowners say they spent more on renovations than planned since purchasing their home, and 64% would rather renovate than move to a home that's already been remodeled. And owning a home is basically a part-time job, because the typical American is also reporting they spend about 17 hours per month, or about 204 hours per year on home maintenance. That's like picking up 3 extra shifts at the gas station per month, guys. So some people tell me in the comments I've read that, I take pride in keeping up with my home maintenance and doing repairs and stuff around the house. I learn things, I save money. There are people who have that personality and I guess outlook on it. But if you're busy and you're somebody who would rather spend your time doing something else besides home maintenance, you might want to second guess this. That could be yet another reason of why you might want to cancel that contract. Think this whole thing through. And if you're worried about
100% agree with him on that. If you don't like doing maintenance and like fixing houses up and like doing these things or learning about them, then there would be a lot more incentive to be a renter for sure. And I think with the way the price in the market is right now, it's cheaper to rent. It's quite a bit cheaper to rent in most markets than it is to buy. And once you own the house, you've got to spend the money on maintenance, the repairs. You've got to do maintenance and repairs yourself. You're constantly project managing or fixing things. It is a part-time job, for sure. It is. It's a responsibility. And if you'd rather spend your time doing other things, don't be a homeowner. I mean, I like it. I like owning the home I live in. I like controlling my environment. Because I understand real estate and construction pretty well, and I don't want to let somebody else control my house, because they're not going to do it as good as I am. I'm going to make sure that the house is well maintained and taken care of, that there aren't leaks, that there aren't major problems. And I know that if I live in a rental property, it will not be cared for as well as I'll care for it. So that's me. But if that's not you, then then you'd have to question, like, well, why do you want to buy a house then? If you're not into maintenance and repair and updating and all that stuff, renting is a pretty good deal financially right now, and it probably will be for quite a while. So I would that's really shifted. I think for a lot of American history, owning a house has been a big way to build wealth. But I think right now, I would not be buying a house to build wealth. That's for sure right now. That's not what I'd be doing. If you're buying a house to build wealth, don't do that. That's not a good idea. You can like rent something and build your wealth through a business, or through, stock investing and other methods. But I would invest your money in other things. Don't invest your money in a house if that's the primary reason for doing it. Don't do that. So go ahead and roll some more.
Not building equity and falling behind that way, you should go check out this video I'm putting on the screen, because the math proves that hands down, it makes way more sense to continue renting and being an investor over a 30-year time frame than owning a home, guys. In fact, it's not even close. The net worth of the investor versus the homeowner over a 30-year time frame comes out to about double. So go check that video out. And by the way, today I'm walking down Sheridan Avenue in Miami Beach and some of the cross
Go ahead and
streets.
pause it again.
Now, I said we were going to talk about Zillow.
So there's a book called Rich Dad Poor Dad, which a lot of people are familiar with in real estate. Like Robert Kiyosaki wrote it, and he talks about how your personal home is a liability, not an asset, and that's totally true. So if you're investing money into a home for you to live in, that home is just costing you money. So it's not an asset like an investment. You buy a house, so now you've got to repair it, you've got to maintain it, you've got to pay the utilities, you've got to pay the taxes, you've got to pay the insurance. It's just costing you money. It's not an asset. It's not an investment. But that doesn't mean there aren't reasons to do it. They're just not good financial reasons to do it. There are just lifestyle reasons to do it. Financially, if you are really financially astute, that's the most important thing for you. You'd want to rent and then invest your money in a high return asset, not a liability. So you can get, the stock market has been very good for a number of years. There's a number of companies that are very good in the stock market still. I think that are good values still. So you'd be better off putting your money in the stock market, or even buying a rental property that does where the numbers pencil out and make sense. Because usually the house that you'll live in, the numbers wouldn't pencil out as an investment anyway. The way that the way that the pricing works out for houses that people like to live in, they're nicer, they're more expensive, they cost more to operate. They're not good investments. But I actually, when I was young in my low 20s, I actually rented a bedroom from a friend to try to keep my living expenses as low as possible. So I lived very low cost, a couple $100 a month with utilities and everything like that. And I just took all my extra income I was saving, and then I bought rental properties that actually cash flowed and made sense on a financial basis. These are rental properties that I probably didn't want to live in myself, but it actually would have been more expensive for me to live in the rental properties than it was for me to live in a bedroom in my friend's house, because my first rental rented for $1,000 a month, and I was paying a couple $100 a month in the bedroom I was renting. So that way I could just keep on buying rentals and keep my cost of living as low as possible. You could move into a bedroom in your rental and then rent out the other rooms. But I had a good friend that I lived with, and we got along well, so it worked out for me to do that. But yeah, if you're young and you want to build your finances, if you want to buy something, buy a rental property or investment property. And if you want to live in a bedroom in that, and it pencils out and makes sense, you can do that. That's going to make sense. I mean, almost in any market that can make sense. I mean, any as the market goes up and down and sideways and everything else, there's almost always opportunities to buy duplexes and triplexes or high bedroom count houses and house hack them and live mortgage free essentially, or even make money living there. So, that kind of stuff is not what he's talking about. It's not what I'm talking about either. Generally, that kind of stuff almost always makes sense to do. So you can still do that now. You could do it a couple years ago. You could do it next year. You could pretty much always do that kind of stuff. I'm always buying rentals too. Some years it's easier than others. Some years it's tougher than others. But there's always opportunities. So if you're looking at investment grade properties, those still make sense. And just depends on your market a little bit too, where you live and where you're buying. But go ahead and roll it some more.
Price forecasts, and this is yet another reason of why nobody should be jumping in with FOMO to the housing market in 2026, guys, even in the hottest markets. And let me show you why. Zillow just updated their 12-month forecast, and they are projecting that U.S. home prices are going to rise 0.9% between January this year and January next year. And that is a downward revision from their original 12-month forecast that they had just 1 month ago, when they thought prices were going to go up by 2.1%. So they've already cut it more than in half in less than a month based on how the year is going so far. And I think they are going to be wrong because Zillow typically is wrong with these forecasts, because look at what it's already showing right now. As of the latest reading, US home prices measured by Zillow's home value index are only up 0.2% nationwide, and they're expecting 0.9%. So how much you want to bet that at some point over the next couple of months, they're going to revise that down even further, and it could even drop to negative. And Zillow probably has more data on the housing market than just about any other big private company. So if they don't even think that prices are going to be jumping much throughout the year, what's the rush, guys? Why worry about it?
Go ahead and
Okay,
pause it there again.
especially when you just look at inflation.
So one of the things to keep in mind, it's, I'm sure, like, as I was watching the video, I'm like, people are probably like, how are prices still going up? How are they? They're going to go up again? Like, they have been going up, kind of. But the way that the housing prices are measured is they're measuring the whole market and then taking a median or an average usually. And I know in Florida, what we've seen is that the higher priced houses still sell. I mean, you still have like $1 million, $2 million houses that just sell fairly quickly. And because the stock market's very high and valuations of assets are very high. And those people are not using mortgages to buy those houses. They don't care about 7% interest rates or 6% or whatever. So if you have these higher priced house points still moving, and the lower price houses that are relying on mortgages not moving as much, the median price points of houses are shifting higher. It looks like prices are shifting a little higher, is what it can look like. There's one metric called, I think Case Shiller has a metric called the housing price pairs, where they actually look at the resale of the same house to see how that exact house has changed, and that's I think a better indicator to look at. And I think the prices have probably been going down a little bit across the country, but you have these little things in the market that can shift price points to make it look like things are actually going up, but they're actually going down. So that, I know down here in Florida, that's more of a factor. Minnesota, not as much of a factor. You don't have as many of these cash purchase multi-million-dollar houses up there as a percentage of the marketplace. Up there, it's more of a mortgage-based market, but even up there, I think prices are up just very slightly year over year. So it's like shocking, like how on earth are prices still going up? The housing market's supposedly crashing. But like he's saying, they're not going up much. I wouldn't be worried about it. They might be up 1% over the last year. They'll probably be down 1% or 2% in Minnesota over the next year, would be my guess. So it's not something that you need to worry about. They're not, you're not going to miss out on anything. So go and roll it.
The inflation numbers have been coming in, and the PCE inflation, which is the one the Fed cares about the most, is still basically at 3%. And so just if you look at that and you take it at face value, okay, home prices go up less than 1% this year, inflation goes up 3%. Effectively, homes actually lost 2% in value, just adjusting for inflation. And that's if you believe the inflation numbers. We know that they're probably a lot higher.
If you're interested in real estate investing and you're tired of scrolling and you want to get some off-market deals at some good discounts.
Oh, thanks, man. Appreciate it.
Yesterday.
Thanks, dude. What's your name?
Dylan.
Dylan?
Yeah.
I appreciate it, man.
Heavy in silver and gold. So I'm 22. I'm learning from you and everybody. So I see you around here. My friends live around here. I'm like, yo, what? No way.
Oh, good, man. I'm glad you learned about that. It's important, especially being young.
Trust me, I got to.
You're going to thank me in 10 years.
I know. I'm already thanking you. Trust me. I got silver probably like 3 years ago.
Nice.
That's when I started.
Nice.
Seeing it now, I'm like, whoa.
Probably pretty happy now, huh?
Yeah, I'm really happy now.
Good,
So,
man. I'm glad to hear that.
Awesome. Thank you so much.
Yeah, good for you, Dylan. Well, thanks for saying hello.
Dylan, nice to meet you.
Okay, take care, Dylan.
Hopefully I see you again.
All right, thanks, man. Thanks for watching. You see, guys, that's exactly what I'm talking about. Dylan here, 22 years old. So he bought silver 3 years ago. Okay, 3 years ago, back when it was probably less than $30 an ounce. And he was 19 years old. Now look at it. Silver is pushing $100 an ounce again in the mid 80s, high 80s, wherever it is. He's extremely happy with that. So it's not like I'm here trying to just, put everyone down and make people feel like they're never going to be able to have anything. I give very helpful information, and if implemented, can change people's lives. And that's exactly the goal on the channel. That's what it always has been, and it always will be, which is why I'm telling you right now, when it comes to buying a home, don't rush in. Even in the hottest markets in the United States, home prices are only predicted to go up about 5.5% this year. And might say, well, that's a lot, Michael, but it's not really when you look at how affordable a lot of these markets are. In fact, the number one on the list is Rockford, Illinois, smack dead next to my hometown of Belvedere, Illinois. Zillow believes home prices are going to go up there 5.4% this year. But when you look down this list, what do you notice? Basically, every single market they mention is either in the Midwest or in the Northeast, which are still the markets that have very low inventory, and the incomes are still enough to match what the home prices are in the area. But if you look at the downside of things, you can see that home prices are expected to drop more in the markets where it's actually dropping than in the markets where it's actually rising. For example, this Louisiana market here, 6.5%, Lake Charles, 5.6%. Those are bigger drops than what we see on the increase side of things. So this shows you that the momentum continues to lean more towards the downside in the housing market, and it's going to continue to be that way. Sure, are some of these markets going up? Yeah, but even the ones that are going up are not going up much more than just the rate of inflation. And of course, if prices are going down in your area, that's even more perfect, because now you're not only getting a lower home price, but adjusted for inflation, that means the price dropped way more. So a 3% price drop could effectively mean a 6 or 9% drop in real monetary terms for you. And look, you don't have to listen to me. You can do whatever you want. I've seen comments saying, oh, I decided to stop listening to all this doomer stuff, and I just decided to buy a house and have a family and live happily ever after. Well, that's good for you. You're probably one of those people that's now getting hit with these big repair costs that maybe you can afford, maybe you can't. I don't know. But if you just jumped in because you're
there's you mentioned the housing doomers. There's kind of a group of guys on YouTube like Michael and there's Reventure, Nick Gurley, and a couple other guys that are, I think people kind of call them the housing doomers. I think they got a lot of traction in the last 4 or 5 years because the housing market was so overvalued, and negative content goes viral much better than positive content does. So these guys kind of, and they also, I think they believe in what they're saying, and that's probably kind of their personality. They're very analytical people. And so they've been doing these kinds of things for years, these videos. And, one of the comments said, like, I'm going to stop watching these housing doomers. And I think you should be careful how much you watch these guys, because it's not completely all true. There's a spin and a bias on all of it. Yes, they have data, but there's a lot of emotion behind it. I mean, if you watch these guys for the last 4 years, you'd think that the sky was falling and the world was falling apart. And it doesn't feel that way. Even in Florida, it doesn't feel that way. And I just saw on his list of housing markets, dropping, there was hardly anything in Florida on that list. There was Punta Gorda, Florida, it said negative 1.9%, which is like, for a market that doubled or tripled in price in a year or two, doesn't even make any sense. I think Punta Gorda is going to go down a lot more than 1.9%. I think it might go down 10% next year or this year. But that's like the epicenter of overpricing and correction. And even at that, it still needs to come down more. So yeah, just be careful. Take the information in for these guys. But you don't have any real. Who's put out videos about good things in the housing market? There's not many. So you gotta be. Take a little, take it with a little grain of salt. I can tell you, I see all these videos about Florida market crashing and everyone's leaving Florida and all this stuff. And I kind of wish it was more true than it is, because I don't see people leaving Florida. I'm sure there's cases of it. Nobody has left my area, my neighborhood. There's lots of houses being built still. People still building and buying houses like crazy. There's crazy traffic. Prices are slowly coming down. So that's more the real world, but that doesn't get headlines. It's not exciting to say that prices dropped 5% last year. What is that? They're still overpriced. So prices drop 5% a year. They're still overpriced. People are still moving here. I don't know. That's kind of more the reality of it. I haven't seen a 2008 type of crisis down here. So I think in 2008, people were fleeing Florida. The economy crashed because it was a housing market economy then. With remote work now, I mean, everybody down here works remotely. Like nobody goes to an office anywhere. So it's not really, in '08, people lost their jobs building houses or whatever they were doing in the housing market, selling houses, mortgaging, doing mortgages and building houses. And then they had to move somewhere else to get a job. And now people down here are from other areas. They brought their jobs with them. They're remote jobs. And those jobs might go away at some point. They haven't yet. But so you don't have the same dynamics going on. And these are also pretty high income people, usually very high income people that came from New York and California and other areas. Seattle is common. And yeah, so it's really changed the economy down here. Before or 5 years ago, the economy down here in the housing market was based on what people could make working down here. And the jobs down here, it's not a great job market down here. So the housing market was actually pretty cheap when we first moved here. It was kind of an attractive thing about coming down here. But now it's almost priced more like it's more affordable than New York and Seattle and California, but definitely more expensive than the Midwest. So it has to stay more affordable than those places because that's where people are moving from because they want to, get a house for more house for less money, live in a nice, warmer state. So, we're not going to get to New York City levels of pricing, but we'll be 20% below that, which we probably are now. And that's kind of where it's at. And I mean, my whole street is Californians and Seattle people and some New Yorkers, not as many New Yorkers as there used to be. It's mostly Californians and Washington State people, it seems like. So, yeah, that's my take on it. So, yeah, it's not all doom and gloom. I do think the housing market should keep resetting. I think be careful if you're a first-time buyer. Be cautious, do your diligence. You don't have to buy a house. You can rent. If you're comfortable renting and you like fixing things, rent. Go invest in, like you said, gold and silver. Silver is, you could have bought silver 6 months ago and you could have quadrupled your money. Gold has gone up a lot in the last 6 months as well. So gold, copper, silver, they're pretty high now. I don't know if I would go buy a bunch of it now, but the stock market still has got a lot of good investments in it. So there's lots of things you can do. You can go buy rental properties in certain markets that still make sense. So you don't have to just put money into a house that's going to cost you money every year. It's not a great financial move, and I agree with them on that for sure. So, well, I think that's probably about it for this one. I don't know that we need to keep watching more of it. So we'll just wrap it up here. So, yeah, hope you enjoyed it. Hope you got some information, you got my bias on it. You got my bias on top of Michael's bias. So he's pretty negative and a doomer. I consider myself pretty conservative, and I tend to be negative I have a negative conservative outlook on investments to try to be safe, but not to the level of Michael and like Nick Gurley and these guys. And I have been following them for 4 or 5 years now. But yeah, I've not seen most of their predictions haven't quite come true like they said. So just take it with a grain of salt and still got to live your life. So that's all I got.